The US dollar took a hit against the Japanese yen after a startling government revision revealed that nearly 1 million fewer jobs were created in the US economy over the past year than previously reported. This unexpected downgrade paints a much weaker picture of the labor market from April 2024 to March 2025, challenging the optimistic initial employment figures and raising questions about the true health of the world's largest economy. Following the release of these revised payroll numbers, the dollar briefly plunged further, but later pared some losses, settling at 147.94 yen, a decline of about 0.3% for the day. But here's where it gets controversial. While the dollar slipped against the yen, it actually gained ground against several other currencies, bouncing back from Monday's setbacks as investors prepared for the upcoming U.S. Consumer Price Index (CPI) report due on Thursday. The Bureau of Labor Statistics (BLS) data showed a downward revision of 911,000 jobs over the 12 months ending in March 2025. To put this into perspective, the previous year's revision for the same period was a reduction of 598,000 jobs. According to Action Economics, this latest adjustment is the largest on record, surpassing the 824,000 jobs revised in March 2009 during the financial crisis and the 818,000 jobs cut in March 2024. This means the U.S. labor market lost an average of 76,000 jobs per month over the past year, far from the robust growth initially reported. Michael Ashley Schulman, Chief Investment Officer at Running Point in El Segundo, California, summed it up with a touch of wit. The only thing growing faster than job growth skepticism is the pressure on the Federal Reserve to finally sneak in some interest rate cuts, because nothing says economic cooling like jobs turning into ghost stories. He added, payroll revisions just turned the job story from fairy tale to audit trail, with the BLS saying the economy created 911,000 fewer jobs between April 2024 and March 2025, the biggest reality check in years. In other words, the jobs fairy just clawed back a lot of cheer. Meanwhile, the broader dollar index edged up by 0.3% to 97.67. The euro, however, continued to weaken, falling 0.4% to 1.1721. Against the Swiss franc, the dollar gained 0.3%, reaching 0.7959 franc. This massive revision raises important questions. How reliable are initial employment reports if such significant adjustments can occur months later? And what does this mean for Federal Reserve policy moving forward? Should the Fed reconsider its stance on interest rates, given this new evidence of a cooling labor market? These are the debates heating up among economists and investors alike. What's your take? Do you think the labor market is truly weakening? Or could these revisions be an anomaly? Share your thoughts and join the conversation below, because when it comes to the economy, every perspective counts.